The European currency fell sharply against the US dollar in early trade yesterday. Although the downtrend remains intact, its significant drop is followed by a recovery. The last trading day was no exception. Market participants received consumer price data. The euro area annual inflation rate came in at 2% in October, up from 1.7% in September and in line with consensus estimates. Core inflation, which excludes volatile components along with energy prices, remained unchanged at 2.7% in October, also in line with preliminary forecasts. The European Central Bank is more or less satisfied with these figures and is widely expected to continue lowering interest rates. As several policymakers emphasized this week, there's a pressing need for monetary policy easing to stimulate the Eurozone economy. Against this background, the euro's decline comes as no surprise. Today's macroeconomic calendar was devoid of any major news releases from the United States, except for housing market data, which turned out to be weak. US building permits fell and housing starts also dropped sharply. This in turn allowed the European currency to recover. Overall, the market remained balanced, with the bearish trend still intact. Likewise, the British pound bounced back after losing value in early trade. Finally, the UK regulator's stance and yesterday's preliminary hearing suggest that policymakers are in no hurry to follow the ECB in cutting rates. The Bank of England is likely to follow the US Federal Reserve in maintaining a more cautious approach to monetary easing. Thus, today's UK inflation data is expected to confirm the regulator's prudent position, despite the fact that the economy is growing at a sluggish pace and some sectors are counteracting. Obviously, the reaction of the UK authorities to Donald Trump's pledge to initiate a trade war is logical, given ongoing concerns about a potential inflation spike. To some extent, this has helped the pound sterling hold steady at one-month highs, and the current sideways movement allows for a continued bullish correction. Before we get into technical analysis, let's take a look at today's macroeconomic calendar. It includes data on UK consumer prices. The inflation rate is estimated to have risen by 0.4% month-over-month and 2.2% year-over-year in October, compared to 0% and 1.7% respectively in September. Data on core consumer prices will be of crucial importance. Core CPI inflation is expected to ease slightly to 3.1% year-over-year in October, down from 3.2% in September. If the reading exceeds analyst consensus, signaling increased price pressures, the British pound is likely to gain value on expectations that the Bank of England may delay cutting interest rates. Traders may also take notice of the ECB Financial Stability Review and German producer prices, although these reports are unlikely to have a strong impact on market sentiment. Market participants are expected to shift their focus to speeches by ECB President Christine Lagarde and Fed policymakers such as Michelle Barr, Lisa Cook, and Michelle Bowman. While their positions on monetary policy are quite clear, they still differ. As a result, the euro may well come back under pressure, with the US dollar continuing its bullish run against riskier assets. Let's now turn to technical analysis. The 1-hour EUR/USD chart shows that the false breakout at 1.0567 and 0.531, the new support level, will make it possible to buy the pair. Going long on a rebound will be relevant at 1.0497, a one-month low, anticipating an intraday correction of 25-30 pips. In case of a rise followed by a false breakout at 1.0610 in response to weak data on the ECB Financial Stability Review and German producer prices, a sell signal would be generated, with the euro potentially sliding to 1.0567 and 0.531. In a bull case scenario, if the price breaks through 1.0610 and consolidates above this level, the European currency is expected to climb to 0.653 and probably 0.694. At this level, I recommend going short on the rebound, counting on the 35-40 pip move. Short positions at 1.0653 and 0.610 can only be considered in the event of a false breakout. Regarding the British currency, the situation is similar. False breakouts at 26.63 and 26.32 will present an opportunity to go long with a target at 1.2716. If the price breaks through and consolidates above this mark, sterling will have a chance of rising to 27.62. At this mark, it would be wise to go short on the rebound to catch an intraday correction of 35-40 pips. Short positions at 1.2716 can only be opened on a false breakout. In case of muted buying activity, if the price breaks through 1.2663 and fixes below it, the British pound is likely to dip to 26.32 and even 1.2599. At this level, I recommend going long on a rebound in anticipation an intraday correction of 35-40 pips. Good luck to all.